The broadcast is now starting. All attendees are in listen-only mode.
Good morning. Welcome everyone to this Fortnightly Market Outlook webinar. I am Devarsh and I am joined by my two colleagues, Nandish and Vinay, for this Fortnightly Market Outlook webinar. So markets are poised quite interestingly, and whether markets are headed lower, higher, what is happening in the global markets, how derivatives are poised. To share all these insights, we have Nandish and Vinay with us. So, good morning, Vinay.
Yeah, good morning, Devarsh Bhai, and hello all, and welcome to this fortnightly webinar for the equity markets.
Right. How are you doing, Nandish?
Fine, Devarsh Bhai, good morning, and hello all, and welcome to this webinar.
All right. So the flow of the presentation will be like this. First, I will speak about what is happening in the global market briefly. Then I'll hand it over to my colleagues, and then they will talk about derivatives and technicals one by one. So, who would like to go first? Vinay, you would like to go first?
Yeah,
After
I will
me?
go. Yeah, sure.
Okay. So first, what is happening into the global markets? So is my screen visible?
No,
Can you
as
see
of
my
now,
screen?
no.
Not visible, Devarsh Bhai. Now visible.
Yes, now visible.
Okay. The presentation is there?
Yes.
Yes.
Okay, great. So what happened in US? The unemployment rate in July unexpectedly jumped, and that led to a sharp rally in bond prices and drop in yields. So more or less now rate cut in September is more or less certainty in US. So this is the most important factor, that the FOMC is going to cut interest rate in US in September. Huge amount of correction has happened in the Magnificent Seven stocks. So those who follow us or keep reading our reports know that the American markets were, especially the S&P 500, was led by the seven large stock technology stocks. Now they are down about 30% from the top, and because they are down 30% and the rest of the market is down only 5%, the S&P 500 is down about 12% from the top. So huge correction. 12% is not a small amount for American markets, but the important thing is that the high flyer, earlier outperformer, are now back to their June, July, the earlier May, June levels, and they have crashed significantly. And that has resulted into the safe haven or the risk of assets period. Now, what is important is that whether this is the cause or this is the effect. I personally feel this is the effect. Cause lies somewhere else. That's where the whole global flow of capital was coming from, and that is Japan. Japanese currency is up around 8% against US dollar over the last 1 month. And because of that, carry trade is happening, and carry trade is now being unwound. Key driver for the global market is the yen exchange rate, and we will continue to monitor this. There, the zero interest rate policy has been now let go. 0.25% is the interest rate in Japan. That means whether money invested in the Japanese stock markets or on the global markets are now being unwound. That money is going back into the currency, and that's why that currency is going up, and that is impacting the global world. People are worried about US. Actually, most important thing is to monitor Japanese bond yields, Japanese currency, and this carry trade can continue to last longer. That means many of the global investors have started hiding in bullion and defensive stocks. Bullion meaning gold and silver, and it is poised for a breakout. In India also, we think that the gold and silver can be a good hedge against your portfolio, which has done quite well. So I'll stop here. The global backdrop is that this inflation is coming down. unemployment is rising, and that means US is likely to cut the interest rates. What is happening into the global markets? If you see the last day, the Friday, you see that the Nikkei has dropped by 5.7%, Taiwan dropped by 4%, small cap index in US went down by 3%, Nasdaq by 2.5%, global MSCI global down by 2%. So the correction across the world has started. Nifty is down by about only 1.25%. So compared to the global markets, our market is quite strong, but the signs are there that it can last a little longer. The S&P 500 VIX is up about 25%. So this suggests that the fear of the global markets is higher. Fear index is suggesting that we should be a little cautious. Now, how far market can fall? What is the Indian technicals are suggesting? I'll invite my colleague Vinay to share his perspective from the charts. Over to you, Vinay.
Yeah, thank you, Devarsh bhai. 1 minute. Yeah, so good morning all of you and welcome to this webinar. So I'm going to speak about the charts, how Indian equity market is looking on technical basis. We will discuss about the different sectors. We will also discuss about the global markets, how they are looking for the short to medium term, and we will do some sort of intermarket analysis which can ultimately impact the Indian markets. So without any ado, I'm starting my presentation. Yeah, so let us start with the Nifty. So Nifty daily chart. This is a Nifty daily chart, and we, as Devarsh bhai seen, have said that Indian markets have outperformed till now. We were just down by 1% on Friday, but if you were to look at the all-time high, which was around 25,078, we are less than 2% down from the all-time high. So till now, great amount of resilience has been showed by our market as compared to the global market. But over the on Friday, closing was not that good because on Nifty almost closed at an day's low, and it closed on a weak wicket on closing basis. So the setup is not that much convincing. I think one should remain cautious. So let us discuss some technicals. So this is a candle which was formed on 4th June when election result came out, and Nifty plunged almost 2,000 points in a day. And if we draw a trend line adjoining the low, which was hit around 21,200, and if we another low which we witnessed was around 24,000 on budget day. If we adjoin this upward sloping trend line, that trend line is actually broken on Friday. So this was a strong support provided by the upward sloping trend line. This was the crucial low formed on 4th June, and this was the crucial low which was formed on the 23rd July budget session. If we adjoin this line, this trend line is broken down. So definitely this is the negative sign as far as the short-term trend for the Nifty is concerned. Now, what is the next support? Now, support for the Nifty, immediate support for the Nifty is seen around 24,400, which is derived from this swing high, which was in between 8th to 15th July. So this was a swing highs 24,400. This is the immediate support, we can say, short-term support, not the great one we can say, but the strong support, the positional support, that there are multiple evidences of the support which gives the level around 24,000 to 24,200. So on a budget day, we witnessed that we saw that 24,075 was the low. And if you were to look at the 38.2% retracement of the entire this rise after the election result, 38.2% retracement also comes around 24,100. So we can say that there is a strong support lies between 24,000 to 24,200. This is the positional support, and as I said, immediate support is there at 24,400, where Nifty could stop going down, but that needs to be reviewed. But overall, we see Nifty coming down towards the 24,000 to 24,200. As we can see over here, this oscillators that we have been tracking, the RSI and MACD, have been trading lower, and they have come down from the overbought zone. See, momentum indicators have also started weakening. So these are all confirmation of a downtrend backed by the weak global markets. Now let us see the weekly movement of the Nifty. Now this was the 8th consecutive. So last week what has happened is Nifty has snapped the 8-week rising streak. So this week Nifty was down by around 0.47%, and after 8 consecutive week of rise, Nifty has started falling. So 8 is a Fibonacci number, and whenever this happens, there is a good chance that the trend might reverse, because after consecutive 8 weeks, Nifty has first time closed in a red. So there is a good chance that Nifty could change its trend from bullish to bearish, at least for the short term. Now let us discuss about the Bank Nifty. So Bank Nifty is also looking weak. It has been underperforming since long, and from the high, which was around 53,500, it has fallen, and till now it has underperformed the Nifty. Nifty is just down by almost 2% from the high, but Bank Nifty is down more than 5%. So underperformance was there, and as we can see here also, the trend line which adjoins the election result low 4th June, and this was around 26th July low. So if we adjoin this upward sloping trend line, it closed around that support only. But as Gift Nifty is suggesting, and as global markets have closed on a weaker note, there is a good chance that Bank Nifty will breach this trend line support. So this is a crucial support. If it breaks, then the next support lies around 50,400 to 50,600. This is the support that we look for the Bank Nifty. As far as resistance is concerned, this is the resistance zone around 52,000 in the spot Bank Nifty. So unless we see Bank Nifty crossing 52,000 on the upside, the overall view remains bearish. On the downside, 50,400 to 50,600 is a strong support. Positionally, we see 49,700 is a very strong support. So that may act as a reversal also as far as Bank Nifty is concerned. So as of now, you can take a bearish view in the Bank Nifty with a immediate downside target of 50,400 to 50,600. And if it is not holding that level, then we can expect even a level of 49,700 in the Bank Nifty. So overall, Bank Nifty is looking weak on the charts. Now let us discuss about the mid cap index. So mid cap index has not fallen on the that much fallen on the Friday. Friday we saw that many healthcare stocks, many pharma stocks, chemical stocks were still hitting new highs on that day. So mid cap has not shown that much weakness on the daily chart. But if you were to look at the overall pattern on Thursday this week, it actually formed the bearish engulfing pattern on the daily chart, which happens to be the negative pattern, a trend reversal pattern. So still the Nifty mid cap index is trading above the 20 days exponential moving average, which is a good sign. Still it has not breached that level, but the way this formation is there, the bearish engulfing on the Thursday, there are good chances that it can extend the fall. So as of now, the setup of mid cap is not weak as compared to the Nifty and Bank Nifty, but we should remain cautious in mid cap also, because in the coming days it might happen that the mid cap stocks can show some follow-up selling. So here also there are some sign of weakness, and we need to be cautious in the mid cap segment. Now let us discuss about some sectors. So Nifty Auto Index. So last week we saw that Auto Index actually broke out from the consolidation. This was the trend line resistance which was actually took out, and after that we saw some rise in the Auto Index. But now that breakout has been negated. In last 2 sessions, Nifty Auto Index has nosedived and underperformed quite a lot. So many large cap auto stocks are looking weak on the charts, and on the back of that, Nifty Auto Index has fallen drastically in last 2 sessions. So it has negated the overall technical bullish setup, and now going and breach this crucial support also. So this is looking weak, at least for the short term. So this could be a profit booking or correction in the overall bull market, but as of now it looks weak. So for next couple of weeks we can take a bearish view on that. Now let us also discuss the important sector which recently outperformed, but on weekly basis this is a negative development. So this is nothing but the Nifty IT index. So Nifty IT index fell more than 3% in the week, and this is a bearish formation in the candlestick charts. This is nothing but the bearish dark cloud cover. This is a negative pattern and can witness some profit booking or trend reversal for the short term. So though it is looking very strong, this was the breakout which happened in the month of June, and after that follow-up buying was also there. But the way it closed on weekly basis, it looks like that it could again come to that breakout level. So 3 to 4% correction could also be there in the Nifty IT index. This can can turn out to be a correction in the overall bull trend. But yes, it is right now looking weak on the weekly charts, and 3 to 5% correction could be there towards this breakout. So current level of the Nifty IT index is at 39,730 levels, so which could come down to 38,500. So around 1,000-point correction could be there in the Nifty IT index as well. Now this is Nifty Realty Index. So this is the weakest sector, we can say, because the Nifty Realty Index has breached the crucial support of 50 days EMA. So this orange line you can see over here. So Nifty Realty Index has closed below the 50 days EMA, which actually most of the sectoral indexes are trading above that 20 and 50 days EMA. But this is the sector which remains high beta, and it has closed below 50 days EMA. So it has underperformed to great extent and now looking weak. This is another evidence. This is the upward sloping trend line adjoining the swing lows, and this actually closed below that level. So this is another confirmation of a weak trend. So Nifty, we have to be very cautious in the Nifty Realty Index. So if market goes down from here as we are anticipating, so Nifty Realty stocks can go down and can continue to underperform in the coming session. So this is the sector which is looking like a reversal, bearish reversal. So we have discussed IT, we have discussed auto indices. Those sectors are looking more like a correction, but Nifty Realty is looking really weak because it has come down below 50 days EMA, and it has also broken down below the trend line support. So these indicators have also been showing the weakness. So there are many confirmations coming from the rationals. So we have to take a bearish view on the realty index going by the technicals. Now let us discuss something about the seasonality. So how August month remains historically. So if we take the history of last 20 years, August month has not given that much return for the Nifty. So the average return of last 20 years for the August month has been muted. It is just 0.51%. As compared to the July, which is more than 3%. So we have already seen a more than 3% rise in the month of July. So seasonality went right over here. We expected that July should remain bullish for the Nifty, and we saw that in the July month Nifty rose by 3.92%. Here you can see, but average return of last 20 years for the August month has been very muted, 0.51%. Success ratio has not been that great. 50-50, you can say, negative and positive returns monthly basis. So after a significant rise in June and July, we can now expect correction in the month of August. This is what seasonality is suggesting. So this is the last 20 years data, and we need to give respect to it. So this is a muted data, zigzag kind of choppiness could be there, but ultimately the returns remains muted for the August month. Now let us discuss something about the global market. So global market, as I said, that have been underperforming. India is outperforming. We are just down by almost 2% from the all-time high, while so many of the global markets and developed markets have corrected more than 15% also. We will discuss now. So this is S&P 500 weekly chart, and for last 3 weeks S&P 500 has been going down, and this is the upward sloping trend line which adjoins the October low, October 2023 low, and this is the May 2024 low. So if we adjoin this trend line support has been violated on the S&P 500. So this is definitely a reversal sign as far as positional trend of S&P 500 is concerned. So as they say that if US sneezes, world catches the cold, it might happen that Indian market as well and Asian market as well can go down, and just because US market have turned weak on the chart. So we cannot ignore this fact, and we need to remain cautious just looking at the weekly and monthly charts of global markets. This is another chart which is a Japanese market, the Nikkei. So from the recent high, Japanese market has actually nosedived by more than 15%. So in last 4 weeks, we can see here, this is a more than 15% fall from the recent high. So we have just corrected 2%, and Japanese market, which is a Asian market and developed market, we can say it has fallen more than 15%. So this is also giving some negative signal in the global markets. This is another index which is a part of Europe index, the DAX, the Germany market equity market index. There is a bearish head and shoulder pattern breakdown on the weekly chart, which is a bearish reversal sign. So European markets are also looking weak, and this is the bearish pattern on the weekly chart, which obviously look heading for the lower levels. So this is also looking weak, and this should impact the Indian equity market sentiment also. Now, this is one underlying which can outperform in the coming days. So this is nothing but the US gold, the international gold, and this is the weekly chart of spot gold in US market, and we can see this was the horizontal channel, and this is the consolidation which was there for last 18 weeks. Now in this week we can see that the US gold has actually closed at an all-time high on weekly basis, and this is also a breakout from last 18 weeks price consolidation. So gold can outperform in the coming times because this was the narrow consolidation which was there for last 18 weeks, and it is a clear-cut breakout on the closing basis. So this is the underlying which can outperform the other asset classes in the coming session. So we are expecting that gold should do well in next fortnight. So to conclude, I would like to repeat again what we have discussed through the charts. Now I'm going to the our conclusion part. The Nifty seems to have reversed the trend from bullish to bearish, at least for the short term. Traders should remain bearish till Nifty surpasses the resistance of 24,900 to 25,000. This was a recent highs we saw in the Nifty. So unless we see this level getting taken out on the upside, we should remain cautious. The immediate support for the Nifty seen at 24,400, which could act as a support for the next week. But far support, which we also mentioned in our monthly report, is at 24,000 to 24,200. Bank Nifty support is seen at 50,400 to 50,600, and far support for the Bank Nifty is seen at 49,700. Resistance for the Bank Nifty is at 52,000. So unless we see this level taken out on the upside, one should remain cautious in Bank Nifty as well. Mid and small cap index has not yet showed any major trend reversal sign, but it is advisable to stay cautious as large cap benchmark indices have turned weak. Global market technical setup has turned bearish as we discussed through the chart, as developed markets like US, Europe and Japan cracks down. S&P 500 VIX has shot up. So VIX is nothing but the indicator of volatility and the kind of fear which is there in the market. So this indicates rising fear and volatility in the US equity market, and that can also impact the sentiment in the Indian markets. Nifty Realty, IT, Metal and Auto indices have registered a major fall last week, and which could continue to be there in the coming session also. So these are the sectors which are looking weak on the chart, especially the Realty Index. Healthcare and pharma looks the strongest amongst the sectoral indices and can outperform. So these are the two sectors which are actually looking very strong and close at an all-time high. They can continue to outperform as a defensive sector. So healthcare and pharma should continue to outperform the other sectoral indices in Indian markets. Historically, August month has not been that great for the Nifty. So that is also a one sign, one rationale, which gives the indication that we should not go aggressively long even if we see a pullback in the markets. Gold as an asset class has broken out from the consolidation, expect it to perform well. And finally, equity trading long position should be lightened, and traders should stay cautious till market gives some positive reversal sign on the chart. So as and when we see market getting reversed from the lower level, then definitely we will review our positions. But as of now, we feel that the technicals are suggesting weakness, and we should remain with the trend, and we should not anticipate the lower levels and reversals. So better to be on lighter side in the long position. And that is what I wanted to share. Over to you, Nandish, who will speak about the derivative developments. Nandish, over to you.
Thank you, Vinay. Am I visible?
Yes.
And my screen is visible, right?
Yes, you can go ahead.
Okay. So good morning, friends. Again, I am going to discuss how the market is looking from the derivative side. So let's straight away start with the presentation. 1 minute. During the week, we have seen short build-up in the Nifty futures, where we have seen 8% rise in the open interest, with Nifty witnessed profit booking from the all-time high levels of 25078 and ended the week with the losses of 0.47%. On the other end, we have seen short covering in the Bank Nifty futures during the week, again, where we have seen 13% fall in the open interest, with the Bank Nifty ended with the minor gains, that is 0.11%. However, on Friday, we have seen short build-up in the Bank Nifty futures, where we have seen 5% rise in the open interest, with Bank Nifty falling by 0.41%. So in Nifty, we have seen short build-up during the week, while in Bank Nifty, we have seen short build-up on Friday.
Devarsh, I think Nandish has got some technical issue.
We are not able to hear you, Nandish. Vinay, can you hear him?
No, Devarsh, he's not audible.
So this in turn indicates that 24,400, 500 is likely to act as an immediate support. If we were to close below 24,400, then we might go down to 24,000 to 24,100, and that's what the option data is suggesting. Now coming to this option distribution chart, as you can see here, we have seen call rating at 24,800 and 25,000 levels, while we have seen put rating at 24,000 level to 24,500 levels. Coming to FI, so although Nifty and Bank Nifty has fallen from the recent high, we have seen long build up by the FIs in the index future segment during the week, where the net bought worth rupees 787 crore, with their open interest going up by 5836 contracts. And that's why FI's net long to short ratio in the index future rose slightly to 1.76 levels from 1.68 levels last week. However, like in Bank Nifty on Friday, they have created fresh short in the index future, where the net sold worth rupees 1395 crore, with the open interest going up by 18296 contracts. So as of now, FI's long to short ratio stood at 1.7. So they are net long, So we can say that they are still long, but if market were to correct from here, you might see a long unwinding or short build up by FIs from here on. So there could be a higher possibility of long unwinding by them if market were to correct, and that may put further pressure on the market. As of now, FIs are still net long. So as you can see from this chart, FI's long to short ratio more or less remained stable during the week, but on Friday it fell to 1.76 from 1.97 levels on the back of short build up by them. So coming to conclusion, as we have seen a short build up by the Nifty, short build up in the Nifty futures during the last week, sharp fall in put call issue on the back of call rating at 21,800 to 25,000 levels, short build up by FIs in the index future segment on Friday, and also weak global views as Vinay has discussed. Our view is that one should remain cautious till Nifty closes about 25,000 levels. On the lower side, as I discussed earlier, there is a support around 24,400 to 24,500 levels where we have seen put rating. If we were to close below 24,400, then we might see a long unwinding by FIs, and also those people who are aggressive longs might reduce their positions. That might drag Nifty to 24,000 to 24,100 odd levels. Coming to Bank Nifty, we have seen short build up in Bank Nifty on Friday. There is a call rating at 51,500 to 52,000 levels, and a short build up by FIs in index future, particularly in the Bank Nifty segment on Friday. Our advice is to remain cautious till Bank Nifty closes above 52,000 levels. On the downside, 50,400 to 50,500 is likely to act as a support level. Any close below 50,400 will result into further long unwinding, which might push Bank Nifty to 49,500 to 49,700. So overall market is looking bearish, but coming to sectors, there are many sectors still they are doing well. So in coming to sectors, there are long build-up we have seen in the chemical, fertilizer, and pharma stocks. So these are the sectors which may outperform during the recent during the downfall, if it all coming. So if market starts falling aggressively, one should create longs on decline in these sectors. While which sectors one should avoid? Auto, cement, defense, and technology. These are the four sectors where we have seen short build-up. As you can see here, auto, cement, defense, and IT. These are the four sectors where we have seen short build-up. So one should avoid these sectors till Nifty closes about 25,000 levels. This is all I want to share from the derivative side.
Yoshvi, are you there?
Yes. Now let's take questions. So if you have any question, I'd suggest you put it into the chat box, and we'll try to answer as many as possible. So I'll wait for a minute or two to get the question queue assembled. Meanwhile, so from derivatives, Nandish, the SEBI is going to announce some measures. We have seen the white papers, and we have seen that the regulator is very concerned about the derivative market. So, what we would like to recommend to many speculators or those who are trading in derivatives is that the limit your exposure towards derivative. We think that the sharp measures can come, and this is the only tool which helps us in a downturn. So those who do not use derivatives in an upturn, we don't require much help from derivatives because we can use MTF, we can use cash market. But in a sideways market or in a downward market, derivatives is the only tool which can help us protect our gains or even profit from shorting. So any advice or any strategies which we think are recommended from our side, Nandish, for derivatives?
Yes, so as we discussed here, market is looking weak. Global markets are very weak. As you discussed, few markets like Nikkei and they have fallen by 15%. So as of now, we are outperforming, but it's better to hedge. And India VIX, it is still at lower levels. It is hovering around 13, 14 odd levels. So option premiums are not that high. So yes, one should definitely hedge because whenever market corrects, it's possible that it might correct sharply because from the election low, June 6, from 21,200 odd levels of Nifty, we are already risen to 25,000 odd levels. So we have seen sharp rise. Many clients must be getting high profit, very good profits in their portfolio. So I think one should, it's better to hedge in such a scenario where global markets are weak. We have issued a bank Nifty bear spread strategy on Friday. So I think it's in such kind of scenario, it's better to do a bear spread where your cost is very low. So if Nifty one were to do a hedging strategy, one can buy 24,500 puts. Premiums are not that high, and one can wait for this August month. One can buy for the August month expiry, 29th August, and keep it open for as a hedging. And for trading, one can enter bear spread in Nifty and Bank Nifty.
All right. Kaushal is asking about textile and chemical sector. So these two sectors are a very small sector, but the quarterly results are suggesting that there could be a possible turnaround in textiles, possible turnaround in the chemical sectors. After 2 years of lower prices on the chemical side and the dumping from the China, the inventory issues are more or less resolved, and there is a possibility that these stocks can also start performing. But Kaushal and others, we may keep this in mind that these are smaller sectors. If they are likely to do well, it is not possible that these stocks go up while the overall global market and the other markets come down. At the most, they can consolidate, they can form a base, and eventually, after a quarter or so, when the quarterly results starts showing up, they will start moving up. But textiles and chemicals are looking relatively stronger compared to the other portions. Shri Hari is asking that if Fed cuts rates in September, what will happen to Nifty? So it is more or less certain. The CBOE market is now suggesting 100% possibility that there could be an interest rate cut in the US. The first interest rate cut will actually induce the market, and that could lead to another rally. So right now we are in the correction phase. After near the September, there could be rally, and once the interest rate cut is there, we have to see where we are. The major driving factor is the earnings, and earnings more or less have held up in Indian markets. Earnings have held up in the US market, though the outlook given by the top 7 companies about the next quarter is not that strong, and that's why we are a little cautious on the global markets. So around Krishna Mohan is asking about the earnings of Nifty 50 companies. Nifty 50 companies are likely to grow. So we are not thinking that this is the ultimate reversal for the market. Indian market, which is trading around 5 trillion, $5.5 trillion, along with the economy, which is around $4 trillion. Gradually, Indian economy is likely to go towards $10 trillion by 2030, 2031. And as and when that happens, Indian market will also surpass these highs and go higher. So this is just a correction. This correction is barely 1 day old. It could be little longer. We don't know. But if it is a longer correction, it is just a correction. We don't think it is a reversal for the longer term. Indian market has a lot of room to go. The flows from SIPs, from domestic institutional investors are very strong. A lot of global investors are looking to invest money into India. They are waiting for better prices. So if there is a 1,000-point correction from top, that will attract a lot of global capital and a lot of money will start coming in. So we are just cautious for the shorter term. There could be some small correction. In that correction, we will looking to deploy capital. There is a question on PSU banks, Vinay. How PSU banks are looking, PSU bank Bs, if you can see the chart and share.
Yeah, sure. So basically, PSU banks have failed to perform in last 3 to 4 months, we can say. So they have been into a consolidation phase when market was doing good, when IT index was going up, the other sectors were performing very well. But PSU bank index has not done that much for the index. So for last 5 months, they are into a narrow consolidation, not able to perform well, and the results from like Canara Bank was not that much convincing. So looking weak, we can say that they can continue to underperform at least for the short term. The primary trend of the index is positive, but for the shorter term, it looks like that they can continue to underperform. The PSU bank is not looking that great on the chart, so one should stay away from taking long positions, aggressive long positions. And there are other sectors which can perform well if market resumes its uptrend. So PSU banks, I would suggest that one should wait. Rather, if market reverses on the positive side, then I see some opportunities in the private sector banks, which actually corrected and now reach the long term support. So private sector banks can perform well if market were to go up from here. For the shorter term, I would rather suggest that one should ignore going long in the PSU banks, at least for the short term.
Okay, so as Vinay pointed out, Kotiswaran K has asked about this question. So earlier PSU banks were trading at 0.5 times book, half a time book, 0.6 time book. Now they have re-rated to about 1 to 1.5 times book. While the private sector banks, which were trading at 3 times, 4 times book, they have come down to 2 times book. So private sector banks valuation have corrected, while PSU banks have outperformed, and PSU banks have now come to a level where they are closing near to their fair value. So as Vinay pointed out, from earnings also, it is important that now we should focus on the private sector banks. Defense sector. So as Nandish pointed out, on derivative side, we have seen that there is a short build-up. Defense have seen a huge rally on back of orders. The overall long-term outlook is good, but prices have gone up to a level where they are discounting the next few quarters. So there is possibility that the defense stocks will consolidate, correct? They will let the earnings catch up, and after 2-3 quarters, when earnings are significant, the valuation will come down, and then again they will start rising. So our advice would be to book profits onto defense sectors. Do not be very aggressive or overweight on defense. There is possibility that these are the pockets of overvaluation where there could be a correction. If you are in the sector for 5 years, 10 years, then these 2-3 quarters of underperformance, if you can digest, then obviously you should at every decline start acquiring these stocks, because over a longer term, we feel that these stocks have a room to go. Same is the case with the railway stocks. Rakesh Upadhyay is asking about railway. So these are also the stocks which are looking very attractive on the longer term, but very cautious on the shorter term. Next few weeks to months, we should expect some correction. Vidyut Paul Bora is asking about cement apart from defense. So cement stocks, as Nandish, can you share the what is the derivative buildup? I think cement was one of the sectors which you highlighted.
Yes, Devarsh. So there are few stocks which are there. There are part of FNO like ACC, Ambuja, Ultratech, Grasim, JK Cement. All have witnessed short build-up during the week. So while there are many mid-cap cement stocks, they are doing very well. They are looking very strong on the chart. The stocks which are there in FNO, in likes of ACC, Ambuja, Grasim, they are looking weak from the derivative side. Technically, also, if I were to see the charts of ACC and Ambuja, they have broken below the short-term support levels. So they are looking weak for the short term. Although for long term they can do well, but for short term I think they are headed lower.
All right. I think we have answered most of the questions which are there. If you have any further queries, you can always connect to us through research group or sending an email. We'll be more than happy to answer your questions. So to conclude, we are seeing the first sign of correction. The levels which we have highlighted are the short-term supports. It is better to be safe than sorry. Do not be overly leveraged on the MTF side or on the FNO side. Try to curtail your longs right now. Hedge it. We have come out with a bank nifty spread, bearish spread strategy. Use them and other recommendations which we will issue from time to time during the week over the next fortnight. Use them. The global setup is little more weaker than the Indian markets. Indian markets are outperforming. Flows are there, and flows will support us at the lower level. But it is better to be little cautious for the next fortnight. Thank you all for joining. Thank you, Vinay. Thank you, Nandish. We'll close this.
Friends. Happy weekend.
All the best. Have a great weekend.